HJRA would eliminate the corporate income, the franchise, and the individual income tax over a 5-year period starting in January 1st, 2015. In the first year, the tax rate would go down to 4% and be revenue neutral on an expanded sales tax base. The current sales tax rate is 4.225, and after the 5-year phase-in, it would be increased to, it would be capped at 7%. There would also be a prebate with a maximum of $2,800 in tax-free spending, maximum 4 per household. The exemptions would be business-to-business exemptions, and the reason for that is it would allow Missouri businesses to export goods without a Missouri general revenue tax component. Insurance, and the reason why insurance is exempt is because there's about a 49-state agreement where if we raised a tax on an insurance company, they'd do the same thing to us, so we didn't want it to drive the insurance companies out of the state of Missouri. But we did remove the business-to-business exemption for insurance companies. K through higher ed would be exempt, and the theory behind that is education is, I would consider, an investment. Gasoline, all the revenues would go directly to MoDOT, so it would not go towards lowering the sales tax rate. And it's all already heavily taxed. And also donations to charity. And like I said, this bill is designed to be revenue neutral. The local sales tax rate would be decreased by nearly 40% due to the expanded sales tax base. So if you had a 3% sales tax rate, it would be reduced to about 1.8. When designing a tax structure, we would never have the structure that we have today. Taxes do damage to whatever government happens to be taxing. I believe the best tax structure is one that is broad-based, so we can have the lowest possible rate. So that way we don't use tax collections to manipulate people's behaviors like we have today. The HJR would increase the economic well-being of the state and allow Missouri businesses to export goods without a Missouri corporate tax component. When businesses pay taxes, they either raise the cost of their goods to incorporate the embedded taxes, or they move to avoid the tax, or they simply go out of business because they can't compete. Every Missourian would have higher take-home pay due to the elimination of payroll taxes from Missouri. This joint resolution would improve efficiency in collections. No longer will we have to look at all businesses and individuals. We will just be looking at businesses, which should increase tax compliance. Estimated fraud from the income tax at the federal level is between 15 and 17%. By having a consumption tax, it makes the tax code more transparent for everybody. It also removes the double taxation underneath our current system through taxes on used items. Taxes on used items will go away after this is implemented, including vehicles and any other product that you would buy that was used.
Let me ask you this. Is the purpose of your bill to bring in more income to the state? Is it to streamline things, to make it easier for somebody? Or is it, in effect, does somebody get sort of a break, that is, higher income people spend a smaller percent of their net income? The more money I make, I don't spend as much as a person who's living, as Representative McNeil commented, on a fixed income. What is the purpose of this? Is it to bring in a lot more revenue, you think?
No, it's designed to be revenue neutral, not bring in more revenue.
Then why do it?
Well, because the idea is to make us a more business-friendly state by eliminating business taxes and promoting people to invest in business. And like, for instance, if let's say you wanted to sell a business today, if you tried to sell a business, you get slapped with an income tax. After this, it would promote money moving through business.
Do you think
and it would also to streamline it.
Do you think that the corporations in Missouri right now are overtaxed?
Well, I think anytime you tax a business, you got to look at who you're taxing.
I mean, in comparison to the states around us, for example, like Illinois or Iowa.
Well, if you tax a business, what's a business going to do? They're going to incorporate it in the cost of their products. Or they're going to move to avoid the tax. Or they're going to simply go out of business because they can't compete.
Mr. Chairman, members of the committee, my name is Jim Moody. I'm representing an organization called Missourians for Fair Taxation. And it's a pleasure to see my friend Ed Emery here in the room. Much of what I will talk about today, I learned some of the basics of this from talking to Representative Emery. And while we would disagree on this issue, he's always been a gentleman, and I've always appreciated the opportunity to talk to him. Mr. Chairman, I have done some analysis on the initiative petitions that have been filed, and I would tell you that is available on my website at jamesrmoody.com under publications. I think you might find that of interest. And part of what I'm going to talk to you about today is how you should look at this issue. On the surface, it sounds great. And when I first started looking at this was, again, when I started talking to Representative Emery, the current sales tax, the 3% sales tax for the state, generates slightly more than $1.7 billion. Replacing all the income taxes and the current sales tax and providing a prebate as provided for by the Show Me Institute would cost $10 billion. Okay, 3% equals 1.7. You need to get to 10%, and yet the bills that were originally filed had a rate of 5.11. And I thought, now how in the world can that be? And the answer is that the 5.11 had no, it was simply an incorrect calculation done by somebody out of the state. And that the calculation is actually included in my letter to the state auditor that I provided. So when you look at this, I think you need to start asking some of those questions, and you need to ask, what is taxed? What is the rate going to be? And that is in part predicated upon what's exempt. And I'm going to talk about what the major changes are here in just a minute. But when you tax services, part of what's going to be taxed is where the poor and the middle class spend most of their money. The one thing that's not been discussed here, you're going to tax rent. Okay? You're going to tax food, and the food is currently not taxed with the 3% state sales tax. It is taxed with the other 1.225% of state sales tax, and it is taxed locally. You're going to tax utilities, which are not currently taxed. You're going to tax child care. You're going to tax, as Representative McNeil indicated earlier, beauty care. Representative White, I believe you may be an attorney. When you send a bill to somebody, your services are going to be taxed. My services are going to be taxed. And so how you get to this big number with an expanded sales tax is you're taxing a lot of things, including to get to this properly at a rate that's been indicated 7%, you have to tax all of health care. Okay? Well, let me give you an example of somebody, and where this is going to fall, this burden is going to fall on the middle class. Frankly, I'm going to find a way around it. And I have the assets to find a way around it. The middle class does not. Let me give you an example of a family that makes $60,000 a year, which I would say is middle class. And let's say they got one child. And they would spend, let's just assume, they would spend $10,000 in rent out of $60,000, $4,000 in utilities, $7,000 on food, and $6,000 in child care. Okay, so out of $60,000, they're spending $27,000 on those items. Their tax burden at 10% is going to be $2,700 just for those items at a 10% consumption tax. At 15%, it's going to be nearly $4,000. They're not paying that much in income tax. And so while it sounds great that we're going to just broaden the tax on services, the people who are going to get hit the hardest are the lower and the middle income people. And that's where the prebate comes in. And the prebate is very expensive. And as you think about the prebate, I would encourage you to think of it this way. As the rate goes up, the prebate has to go up because it's taking more of their money as the rate goes up, the people who most need the prebate. And again, I would tell you that the concept of the prebate, as in the fair tax book, is that every citizen would get it. And so you don't have to set up a bureaucracy to determine who's eligible or not. And so all of us in this room would get a prebate. And in the course of doing that, you know, we might pay more of the taxes because we might have more income than other people. But so the idea is that everybody gets the prebate. In both the initiative petitions and in Representative Koenig's bill here, there's really no money for the prebate. The initiative petitions are taxed at 7%, and all that is needed, or they're capped at 7%. All that's virtually needed to replace existing revenues. And Representative Koenig's bill here takes the 5 years of current revenues, which in itself I think is a problem, but takes 5 years of current revenues and says we're going to take that average and that's what we're going to replace. Well, to state the obvious, we're not currently paying for a prebate, and since all you're doing is replacing current revenues, which are already being spent, there's no money there for a prebate. And since this is a constitutional amendment, to establish a prebate, you would have to amend the Constitution. Now, the calculation of what the prebate costs, and this is not my calculation, at 5.79%, the prebate costs $2 billion. And that's from the Show Me Institute. That is not my calculation. It is included in my letter to the state auditor. I simply directly quoted what the Show Me Institute publication said. To fund the prebate, even at $2 billion, you're going to have to increase the tax rate probably 2.5% to 3%. And again, the $2 billion is only a 5.79% rate. And the other thing that kind of happens here is when you start funding the prebate, it's kind of a vicious circle. As the tax rate goes up, the prebate amount goes up, and then you need more revenue to pay for the prebate, so the tax rate has to go up. And so anyway, you know, in theory, this thing sounds great. In actuality, I think it's got a myriad of problems. And you know, the question is, why would somebody move? Well, if you're going to tax my rent at 12 to 15%, and I'm in Kansas City or St. Louis, I'm going to move across the border. If you're going to tax my services, if I'm in Kansas City or St. Louis, at 12 to 15%, whereas you know your marginal rate right now may have been 3 or 4% on income tax, you're going to move across the border. And so this thing has far-reaching ramifications.